Thanks for checking out another clip of the Cashflow Contractor. We'd love to have you as a part of our audience. Click subscribe wherever you get your podcast. What does a line of credit typically look like? Why should I consider a line of credit versus a credit card? Let's talk about that for a minute.
Yeah, happy to. And I'll do so from the perspective of the construction industry, because that's where we spend a lot of our time. And, the majority of our clients come from that space. So a line of credit in the construction industry serves a few purposes. One of the biggest reasons that a lot of construction businesses want a line of credit is that it expands their bonding capacity, meaning you can actually serve more revenue because you can get more bonds on bigger jobs to be able to win larger jobs and more work. And the ability to show access to capital directly impacts your bonding capacity. So a lot of construction businesses will go out and open a line of credit and never touch it. They don't need it. They don't need access to the money. They just want the
bonding. Is there any danger in not touching it? Like, is the bank going to revoke that from you?
Not usually, but certainly you want to make sure you understand the terms and conditions that you have with your specific bank. They don't require some transaction activity to flow through that account to keep it open. If they do, you draw 20 grand on it once a year and then pay it off, right? Just keep it open. But it's also really nice to have there because you don't know the future, right? You don't know when the next financial crisis or global pandemic is going to hit, and you need access to $500,000, $1 million, $5 million line of credit, depending on the size of your business, to make payroll, keep your business open, to be able to weather tough times. Like it's something you really want to have there because it helps mitigate a lot of the risk of uncertainty.
Okay. So that's the line of credit. You mentioned credit cards, so you can get credit cards directly through your bank rather than going through Capital One or whatever it is.
Hey, real quickly, back on line of credit. The flip side of that just comes up a lot with clients is you max it out, and banks typically want to see that line of credit go to zero sometime through the year. And I tell people, whatever you got to do, pay it off on Monday, take it back, or on Friday and take it back on Monday. Maybe you have something to speak to that. They're always scared that maybe they won't loan it back to them.
Yeah, no, you're 100% right. It's not a line of credit. It's a revolving line of credit is really what it is. Meaning they want it moving. They want it cycling. They want you drawing, paying, drawing, paying, drawing, paying. They don't want you using it as a term loan. It's not, I get a $500,000 line of credit and tomorrow I go draw $500,000 on it and buy something for $500,000 and make interest only payments from that point forward, right? That's going to be considered abuse of the line of credit in the eyes of the bank, and they're going to shut you down.
Yeah, they'll term it out on you.
They will.
Yeah.
And then they'll never give whatever cost again.
Right.
Yep.
Gotcha.
So just something to be aware of. I don't know that you always have to go to zero, but like you said, Luke, they want to see significant change up and down, evidence that, okay, there's money flowing through there.
Yeah, they must see you using it for short-term capital needs.
Okay, so line of credit for short-term. What can you explain benefits of doing the line of credit versus a credit card? Is just the interest rate going to be different?
The interest rate is typically more favorable, and usually you get access to more credit, right? A credit card limit is usually going to be quite a bit less than what you could get from a line of credit.
Okay, gotcha. And what's the typical interest rate? I mean, obviously it can be all across the place, but what should you be shooting for in a line of credit these days? It's March 2025. You'd have to look it up.
Yeah, I mean, there's so many variables that impact that. One bank to the next is extremely different. Your credit worthiness versus somebody else's credit worthiness.
Okay, what's the lowest you've seen and the highest you've seen maybe?
The highest I've seen on a line of credit, it's like 15%.
Okay.
Wow.
Lowest I think I've seen recently is like 8 or 9.
8 or 9. Okay. So, but then on credit cards, you're looking at 20 plus. So oftentimes maybe 30 if you're really bad, right?
Yes, they can be pretty significant.
Yeah. Okay. Gotcha. So let's talk about the SBA for a second. That might be for more of those assets that you shouldn't be purchasing with your line of credit. So yeah, talk to us a little bit about SBA.
Yeah, the SBA is a great program. It's pretty easy as long as you're somewhat creditworthy to get access to SBA funding. And there's kind of different tiers of SBA lending, if you will. You can get SBA funding through a bank, but a bank is only going to offer SBA funding to what they would consider to be A tier creditworthiness. So if you've got excellent credit, you can get SBA funding through a bank. If you're struggling and you're maybe what they would consider to be more of a B or C tier borrower, a bank is not going to give you SBA funding. But there are other third-party lenders that are not banks that will do SBA funding for lower credit-worthy borrowers. So just because your bank says no to SBA funding doesn't mean you don't have access. It just means you may need to pursue it through a different lender.
Okay.
How in the heck does that work? Well, go ahead, Khalil. But
what I was going to say, I've only heard about people going through a bank. So I'm curious who these third-party lenders are, how that works.
Yeah, they're standalone. Like I've got a guy in my network who does SBA lending, and he does it through other finance companies that he has access to. They're not like brick and mortar commercial, public facing banks. Like you can just walk into a branch and deposit money, right?
Sure.
These are lending institutions. They are set up to lend money, and they have a little higher risk tolerance than a bank does. And so they will do SBA loans with lower creditworthy borrowers.
And they're sourcing their money from investors or
it's
institutions,
still it's still coming from the small business.
So the SBA is guaranteeing it. Are they providing? They provide the cash or guarantee the cash?
I think they just guarantee the cash.
Yeah.
So that's why you can go through some third-party lenders who have a higher risk appetite, and they'll still do SBA type funding to higher risk borrowers. This is a lot more expensive, right? You're looking at significantly higher interest rates than what you get through a bank if you were an A-tier borrower.
Gotcha. Okay. And you use the SBA for purchasing equipment, for acquiring a company, can you use it for debt consolidation?
Yes, I believe you can. I think there is, I can't remember the designation. There's a few different types of SBA loans that you can get access to. And I know there's one that you can use for debt consolidation if you're able to qualify. It can be a little harder. You may not be able to do it if you're like a C tier credit level. But yeah, if you're an A tier borrower and you want to do debt consolidation, there are some SBA products that you can use to do that.
Thanks for checking out a clip from the Cashflow Contractor. We have full episodes where we go deep on topics that help you grow a construction business that runs without you, so you can have less stress, more time, more money. Now, we've got other videos, other clips, but if you want to check out the full episode for this clip, you can click wherever our editor put it. It might be here, it might be there, it might be over my face, I don't know. But thank you for checking us out. We'd love to have you as a part of our audience. So subscribe or check out a full episode wherever you get podcasts.